Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. In this episode, we will talk about correlation in financial assets, which allows you to make better diversification decisions and adds another layer of information to your investing strategies. If you want the code behind the dashboards or a written version of the material, there's a Patreon link below, but let's get into it. Before getting into correlation, we should first go over diversification, which we have only briefly touched on in previous episodes. Investing in a single asset exposes you to both idiosyncratic and systemic risks. Think about a bikini business suddenly facing an ice age. If that's your only investment, you're probably in trouble. The idea behind diversification is simple. Instead of relying on one asset, you invest in multiple assets that are exposed to different risks. That way, when one investment performs poorly, others may not, and your overall portfolio becomes more stable. It's also important to know that diversification is not limited to stocks. Most diversified portfolios include a mix of asset types, from equities to bonds to commodities. Beta, which we recently covered, gives you a measure of market exposure that you can use to diversify to a certain extent. But it's not ideal because it is tied to a specific market and asset type. What we need is a general way to say, when this asset moves up or down by this much, this other asset moves up or down by this much, and that's where correlation comes in. Correlation is a way to measure how two assets move relative to each other. If both assets tend to move in the same direction at the same time, they have a positive correlation. If one tends to go up while the other goes down, they have a negative correlation. And if their movements don't show a consistent relationship, then their correlation is close to zero. If you combine assets that are highly correlated, you're not really diversifying. You're just holding variations of the same thing. If you combine assets with low or negative correlation, their movements can upset each other. To actually measure correlation, we need to compute it from historical data, typically using asset returns. Most tools like spreadsheets, programming language, or statistical libraries have correlation functions built in that you can use directly. Under the hood, what they are usually calculating is something called the Pearson correlation coefficient, which looks like this in formula. In practice, you don't need to calculate this by hand. For our example, we'll use the built-in correlation function in Google Sheets applied to historical returns. Let's take four assets: the S&P 500, NVDA, Coca-Cola, and JP Morgan. After running the correlation function on yearly returns, you should get a matrix like the following. Correlations are usually displayed in matrix form because we are comparing multiple assets at once. And if your calculations are correct, you should see ones where the same asset intersects itself, as that is the perfect correlation. In our example, you can see some correlation groupings. SPY and NVIDIA at 0.74, SPY and JP Morgan at 0.75, and NVIDIA and JP Morgan at 0.48. These are relatively high positive correlations, which tell us these assets tend to move together. Now compare that to Coca-Cola in that period. SPY and Coca-Cola is 0.05, NVIDIA and Coca-Cola is negative 0.24, and JP Morgan and Coca-Cola is 0.08. These values are much lower, and even negative in one case, which tells us Coca-Cola behaves differently from the others. Knowing the correlations between assets allows you to build portfolios with different performance profiles. Consider two portfolios. Portfolio A holds SPY, NVIDIA, and JP Morgan, and Portfolio B holds SPY, NVIDIA, and Coca-Cola. In Portfolio A, the assets are all fairly correlated. When one moves, the others tend to move with it. In Portfolio B, Coca-Cola has a low or even negative correlation with the others, so it behaves differently. Portfolio A is more concentrated. It can perform very well when those assets are doing well, but they can also decline together. Portfolio B is more diversified because not everything moves together. Its performance tends to be more stable. Diversification through correlations does not guarantee higher returns, or even that the correlations will hold into the future. In some periods, a more concentrated portfolio like Portfolio A may outperform. Correlation also does not imply causation. Just because two assets move together doesn't mean one is causing the other to move. In financial markets, correlations often reflect shared exposure to broader factors like economic conditions, interest rates, or investor sentiment. Like many things in quantitative finance, over-relying on a single metric might not give you the results you want, but ignoring it might also get you in trouble. Consider correlation alongside other metrics when building your portfolio or investment strategy. Thanks for watching, and I hope this helped you understand correlation. If this was useful, please consider subscribing to Quant Matters here or supporting the channel via Patreon.